All right, welcome to This Explainer. Today, we're diving straight into the financial health of Edison International. Think of this kind of like a comprehensive medical checkup, but instead of a human patient, we are examining a massive $26 billion corporate giant. We're going to use the hard data to see exactly what's thriving, what's a bit concerning, and what might be hiding just beneath the surface of this historic utility company. Now, what if I told you an old-school utility company saw its earnings per share absolutely skyrocket by 446% in a single trailing 12-month period? A 446% jump in EPS is the kind of explosive metric you'd normally expect from some hot Silicon Valley tech startup, not a legacy power provider. It completely grabs your attention, right? But as we'll see, the headline number never quite tells the whole story. So, to make sense of this massive earnings jump and the rest of the company's complex data, we're organizing our analysis into an investor's scorecard. We'll be looking at 1. The Edison snapshot, 2. The dividend dynamo, 3. Explosive growth, zero cash, 4. Valuing the utility giant, and 5. The debt and risk reality. Let's jump right in. Starting things off with Section 1, the Edison snapshot, where we're checking the vital signs. At a quick glance, EIX is trading right around $68 a share. It carries a hefty market cap of $26.34 billion, which makes it a true heavyweight in the utility sector. And look at that momentum. It's showing a really robust year-to-date return of over 17%. If you just looked at these three numbers, you'd probably say the patient is in exceptionally good health. But check out this chart, because it brilliantly illustrates the stock's recent volatility. Utilities are generally thought of as slow, steady, and frankly, a bit boring. But EIX has been anything but. We see a solid 2024 with over 15% returns, followed by a brutal 20% nosedive in 2025, and then a massive bounce back this year. So it's definitely been a bit of a roller coaster for shareholders over the last 36 months. Moving right along to Section 2, the dividend dynamo, the reliable engine output. Currently, EIX boasts a dividend yield of 5.12%. This just means shareholders are getting a generous cash return every year, literally just for holding the stock. In a market where a really high yield can sometimes be a red flag, a 5+% payout from a massive regulated utility is traditionally seen as an incredibly attractive anchor for an income-focused portfolio. And the absolute crucial point here is consistency. Edison has successfully bumped up its dividend for 22 consecutive years. That is more than 2 decades of predictable, growing income. Furthermore, they're maintaining a payout ratio of just 29.45% against their earnings. So on paper, that suggests the dividend is incredibly safe, mainly because they're only paying out about a third of their net income to shareholders. Hold that thought, though, as we hit Section 3, explosive growth, zero cash, the great contradiction. Okay, this is where things get really fascinating. We have a massive disconnect. On one hand, recent net income grew by an explosive 247% over the trailing 12 months. That totally aligns with that crazy 446% EPS jump we saw at the start. But in stark contrast, the free cash flow growth over the last 3 and 5 years is dead flat, 0%. How can a company triple its net income but not grow its cash flow? It's a textbook example of accounting profit totally diverging from cash reality. Actually, scratch that. Looking at the trailing 12 months, the actual free cash flow is sitting at negative $715 million. You heard me right, negative. They generated a massive accounting profit, but more cash actually went out the door than came in, driving a staggering price-to-free cash flow ratio of negative 37.02. This right here is the central tension of Edison International. You just can't pay a growing 22-year dividend with accounting math. You need cold, hard cash. And right now, the operational cash register is coming up short. So with this glaring disconnect between the accounting profit and the actual cash, let's look under the hood in Section 4, valuing the utility giant. When we compare EIX's current price-to-earnings ratio against its 3-year historical average, we see the stock is trading at an unbelievable 61.9% discount. A PE ratio of 5.94 is practically unheard of for a massive utility. The market is clearly looking at those explosive short-term earnings and heavily discounting them, mostly because investors see that negative free cash flow and aren't fully buying that the earnings growth is a permanent cash-generating reality. And if we factor in that massive short-term EPS growth, the PEG ratio drops all the way down to 0.02. And no, that is not a typo on the slide, that's the actual number. The PEG ratio measures valuation against growth. Because the trailing growth was so historically enormous, the math spits out a valuation that looks practically free. But a 0.02 PEG ratio on a company bleeding $715 million in free cash flow? Yeah, that is a massive flashing signal to dig deeper into the risks. Which brings us to our final stop, Section 5, the debt and risk reality, checking the cholesterol. Look, heavy-duty utilities absolutely need massive amounts of capital fuel to run. Building and maintaining the power grid is wildly expensive. But EIX currently uses over twice as much debt as it does equity, sitting at a debt-to-equity ratio of 2.30. On top of that, both of its liquidity ratios, the current ratio and the quick ratio, sit uncomfortably below 1. Let's translate that into their daily financial reality. Simply put, a 0.73 current ratio means for every single dollar of bills due in the next year, they only have 73 cents in easily accessible assets to pay them. They're heavily relying on their ability to just continuously borrow and roll over debt to keep the lights on and keep those dividend checks clearing. So, as we wrap up this explainer, we are left staring at a really fascinating financial puzzle. We've got a utility with a fantastic 22-year history of dividend hikes, trading at an extreme historical discount, with massive accounting earnings. But on the flip side, it's carrying negative cash flow, a heavy debt load of 2.3 times equity, and short-term liabilities that easily outpace its liquid assets. You have all the data on your scorecard now, so I'll leave you with this. Does that reliable 5.12% income really outweigh the underlying debt and cash flow risks lurking just beneath the surface?